Assalamualaikum warahmatullahi wabarakatuh. There are 4 points of the importance of capital budgeting in the business. The first one is create responsibility and measurability. If the business is involved in the invest without understanding the possible outcomes and risks from any decision were made, then it would be considered there is no chance for business to survive in a competitive marketplace if they do not measure effectively.
So the second one is estimate and forecast future cash flow. Future cash flow is a method of discounting cash that company or any business expect to receive that value in the future. Executive can start the project if there is capital budget and also estimate its future cash flow to determine if such a project should be accepted.
Another importance of capital budgeting in business is with capital budgeting, company can develop and formulate a long-term strategic goals. The strategic plan can estimate the value of the investment of a project, and a good estimation of a project investment will enable a company to build a good framework structure with a better longevity.
For the last one is facilitate the transfer of information. With the capital budget, the process to transfer the information would be easier to the decision maker in the company.
Payback period is the amount of time required for the firm to recover its initial investment. If the project's payback period is less than the maximum acceptable payback period, accept the project. If the project's payback period is greater than the maximum acceptable payback period, reject the project. Management determines maximum acceptable payback period. This is example of payback period for even cash flows. The following is the formula. Initial outlay divided by cash flows. These are the tables that as you can see, and the calculation is below that. Payback period is RM 20,000 divided by RM 10,000, which is 2 years.
Okay, this is the example of the payback period technique. First, we need to identify the formula of this technique. Okay, the formula to calculate the payback period method is the year before full recovery plus the uncovered cash flow or CF and divide by cash flow during the year. Okay, now how to get the payback period value is we need to identify each value of each formula. Let's see the example here. To get the answer is we need to calculate year before full recovery, which is 1 year, plus the uncovered CF RM 5,000 and divide by CF during the year, which is RM 15,000. Then we get the answer, which is 1.33 years or 1 year and 4 months. That's all.
There are 3 advantages of payment method. First is the payment method is easy to understand. Second, the payment method only focus on the cash flow and not accounting profit. Third, the payment method reflects the true timing of benefits and costs.
Disadvantages of payment method. First, it does not count properly for time value of money. Second, it does not account properly for risk, especially for long-term project. The third is ignore the cash flows beyond the payment period.
Next, discounted payback period. The discounted payback period is exactly the same as the regular payback period, except that we use the present values of the cash flow in the calculation. Discounted payback accounts for time value of money. Apply discount rate to cash flows during payback period. ignores cash flows after payback period. Note that the discounted payback period is always longer than the regular payback period.
This is the example of discounted payback period. Assuming the cost of capital is 10%, as you can see in the table below, there is an equation which is discounted payback period equal years before full recovery plus uncovered cash flow divided by cash flow during the year.
Advantage of discounted payback period. First, it's enable company to consider the riskiness of the project cash flow mean through the cost of capital. And next, second, it's allow the company to consider the time value of money.
Next is disadvantages of discounted payback period. Firstly, ignores the cash flows beyond the payback period. And then second, requires an estimate of the cost of capital in order to do the computation.
Major difference between the discounted payback period and the payback period is in discounted payback period, it took into account the time value of money. The time value of money means that the money now is more valuable than the same amount of money in the future. Which means that the principle implies that the discounted payback period will be longer than the standard payback period. And also, in discounted payback period, it also involves the calculation of compound inflation, which means that the process is not as straightforward as that for the standard payback period.
That's all from us. Thank you.